Hello again, and welcome to our Week 2 live chat for FIN4126 Financial Decision Making and Planning. I'm Dr. Mark Dennis, and in this session we're going to walk through some of the most critical personal finance principles that will serve as building blocks for everything else we're going to cover this term. These aren't just academic concepts, these are real-life decision-making tools. Let's get started. This week's focus is all about getting familiar with concepts that have a lasting impact on your financial well-being. Think of this as a short list of must-knows when it comes to borrowing money, managing risk, and understanding returns. If you grasp these now, your future financial decisions, whether personal or professional, will be that much stronger. Let's begin with inflation. Over time, inflation reduces the number of goods and services you can buy with a single dollar. This is known as purchasing power risk. For example, $100 today will not buy the same amount of groceries 10 years from now. That's why we need to earn returns on our investments that at least keep pace with inflation. If not, we're essentially losing money in real terms, even if our account balance continues to grow. Now let's talk about leverage. When we borrow money, those monthly payments become part of our fixed costs. And if our debt payments get too high relative to our income, we're then considered to be over-leveraged, and that can quickly spiral into financial trouble. Responsible borrowing, knowing how much debt we can comfortably carry, is essential to long-term financial health. Credit underwriting. When you apply for a loan, lenders don't focus very much on why you want to borrow. They're much more concerned about whether you can pay it back. The underwriting process evaluates your income, your overall debt load, and your repayment history. A strong credit score and reliable income make you a lower risk borrower. And that means better interest rates and more favorable loan terms. Types of home mortgages. Home mortgages are not one size fits all. There are conventional loans for most buyers, jumbo loans for high value homes, and government insured loans for those who qualify. Then there's the choice between fixed and adjustable rate mortgages. Fixed rates offer stability, while adjustable rate mortgages can start with low payments, but they come with more risk if interest rates rise. Choosing the right mortgage is about aligning your financing with your financial goals. Risk. Let's pivot to the concept of risk. Risk is essentially the chance that an investment's outcome will differ from what we expected. There are many types of risk. Market risk, which affects all investments. Liquidity risk, where you might not be able to sell without incurring a loss. And economic risk, which can come from broader downturns. Inflation risk also fits here, especially for conservative investors whose returns may not keep up with inflation. Additional risks include political and regulatory changes that can hurt business performance. If you invest internationally, currency risk also becomes a factor. Technology can make entire industries obsolete. Just ask Blockbuster. And shifts in consumer preferences or industry conditions can also derail a company's prospects. Bottom line, every investment carries a mix of these risks. Diversification helps you manage them more effectively. Risk can also be measured. The most common way is by looking at how much an investment's price fluctuates, also known as its standard deviation. The bigger the swings, the higher the risk. Two stocks might have the same average return, but the one with wilder ups and downs is the riskier stock. This is why diversification matters. Spreading your money across different assets can reduce overall volatility exposure. Let's close with return, also known as what you get back on your investment. Time-weighted returns measure performance over a period regardless of when money is added or withdrawn. A related concept is the internal rate of return, or IRR, which factors in the timing of cash flows. For bonds, this internal rate of return is often referred to as yield to maturity, and it reflects the total return if you hold the bond until it pays off. Knowing how returns are calculated is key to making informed comparisons. That wraps up our walkthrough of Week 2's key learning concepts. If you have questions or you want to dig deeper, please don't hesitate to reach out. You can always email me, call, or text. I am here to help you succeed. Understanding these foundational principles now will make you a smarter, more confident financial decision maker.